Why are you paying more? You pay more because you're poorer. I'll tell you how. If I could please ask you to subscribe, press the bell button, and don't forget to leave a comment. Thank you. Now let's get started. Companies do not ask what a product should cost. They ask what each customer can tolerate paying, and then they charge accordingly. This is called price discrimination, and it is everywhere. It does not require explicit income data. It relies on signals: location, behavior, urgency, payment method, lack of alternatives. Those signals correlate strongly with income and flexibility. People with fewer options generate stronger pricing signals. They shop closer to home. They buy at specific times. They use certain payment methods. They cannot wait for sales. Those patterns are visible, and they are monetized. Price discrimination does not always look like higher sticker prices. It often shows up as fewer discounts, more fees, smaller quantities, worse terms. Two people can buy the same product and pay different effective prices, not because of luck, but because of how the system classifies them. Grocery pricing is a clear example. Stores track which neighborhoods are price sensitive and which are price captive. Areas with fewer competitors have higher prices. Areas with less mobility have fewer promotions. Areas with higher urgency see more shrinkflation and fewer sales. The result is simple. Households with fewer choices pay more per unit. Discounts are not generosity. They are filters. Sales are designed to reward flexibility. If you can buy in bulk, if you can wait, if you can travel, if you can switch stores, if you cannot do those things, you pay full price more often. Fees work the same way. Late fees, convenience fees, delivery fees, minimum balance fees. They target urgency and constraint. People with time and liquidity avoid them. People without absorb them. Subscriptions are another example. Lower-income households pay more because they cannot prepay annually. Monthly pricing carries a premium. Cancellation friction extracts additional value. Transportation pricing follows the same logic. Peak pricing targets urgency. Limited routes target lack of alternatives. Longer commutes increase exposure. Housing is the most punishing version. Renters pay more because they cannot choose timing. They cannot delay. They cannot substitute. Application fees, admin fees, pet fees, move-in fees. These costs do not reflect value. They reflect leverage. Insurance pricing also discriminates quietly. Credit scores, zip codes, payment history. Each one is a proxy for risk and income. Each one increases cost for those with less margin for error. This is not accidental. Price discrimination works best when it feels invisible, when no one feels singled out, when differences appear random, but the pattern is consistent. People with less flexibility pay more. People with fewer choices subsidize lower prices for others. This is why inflation hits harder at the bottom and middle. Price discrimination amplifies inflation. It directs the biggest increases toward the least flexible households. Inflation raises the baseline. Price discrimination determines who absorbs the most pressure. Together, they create compounding stress. Most people sense this intuitively. They just don't have the language for it. They feel punished for being broke, because they are. Not morally, structurally. This is the part that rarely gets explained. To understand why you pay more because you're poorer, you have to look at how data sorts consumers into categories. Pricing systems no longer treat everyone the same. They treat you as a profile, not a person. Profiles are built from behavior. Behavior signals constraint. Constraint signals pricing power. The system is looking for who has alternatives and who does not. If you have alternatives, the system has to compete for you. If you do not, the system extracts from you. This is how competition and extraction coexist. Not all markets are competitive for all people. A wealthy neighborhood may have multiple grocery stores, multiple pharmacies, multiple clinics, multiple hardware stores. Choice creates downward pricing pressure. A lower-income neighborhood might have fewer options, less variety, more consolidation. Limited choice creates upward pricing pressure. Price discrimination is not just about what you buy. It's about where you are forced to buy it. Retailers map neighborhoods based on price tolerance. They do not need to know your exact income. They know your zip code. Zip code predicts spending power. Zip code predicts mobility. Zip code predicts competition. Zip code predicts substitution behavior. This allows price discrimination to operate quietly and legally. Digital platforms do the same thing in more precise ways. Online retailers track what you browse, how long you browse it, how often you revisit it, and how urgently you buy it. They track whether you abandon carts. They track whether you compare prices. They track whether you wait for sales. Those signals determine discount eligibility. People who wait get discounts. People who don't wait subsidize them. Urgency carries a premium. People with time pay less. People without time pay more. Time itself becomes a form of wealth in price discrimination. Payment methods matter too. Annual billing is cheaper than monthly billing. Monthly billing is cheaper than pay-as-you-go. The poorer you are, the more likely you are to use the most expensive billing model. This is not because poorer people are irrational. It is because they cannot commit to long-term contracts. They cannot absorb large upfront payments. Flexibility costs money. People with liquidity purchase flexibility. People without liquidity pay for immediacy. This pattern appears in transportation as well. Ride-sharing platforms use dynamic pricing. Surge pricing targets urgency. Late-night pricing targets captivity. Captivity is when the customer cannot reasonably say no. When alternatives disappear, prices climb. There is no negotiation under captivity. Captivity can be geographic, temporal, financial. The system does not need to know your income to detect captivity. Your behavior reveals it automatically. Insurance pricing uses credit scores as a proxy for risk and income. Poor credit results in higher premiums for the same coverage. People with less margin for error pay more for protection. This logic extends to banking fees. Minimum balance fees target low liquidity households. Overdraft fees target timing mismatches. Late fees target constraint. People with more cushion avoid these fees. People without cushion fund them. The system uses penalties to monetize instability. Price discrimination also exists inside education. Wealthier students pay lower interest rates. Wealthier families negotiate tuition. Wealthier applicants receive better scholarship matching. Meanwhile, lower-income students borrow more and pay more over time. Price discrimination becomes a compounding disadvantage. You pay more because you cannot afford to pay less. That phrase sounds circular, but it describes reality. When you cannot purchase in bulk, you pay higher unit prices. When you cannot prepay, you pay higher rates. When you cannot wait, you pay urgency premiums. When you cannot switch, you pay captivity premiums. Price discrimination magnifies cost differences between classes. Even when the sticker price appears identical, corporations deny price discrimination publicly, but they engineer it privately. It increases revenue without raising political alarm. It increases profit without headline inflation. It increases extraction without direct confrontation. Most consumers do not detect it. They only feel the pressure. They assume they are simply bad at managing money, because the system benefits when they believe that. Self-blame protects structural incentives. It prevents resistance. It prevents collective bargaining. It prevents systemic scrutiny. If people believe their struggle is personal, they do not ask why the system is designed this way. Meanwhile, the wealthier classes enjoy the inverse effect. They receive loyalty rewards, bulk discounts, cashback, lower interest rates, better insurance terms, lower fees, priority access, subscription bundles. In other words, the wealthy pay less for the same products and services. This is the core of price discrimination. The poorer subsidize the wealthier, not just through taxes or wages, but through prices. This mechanism is invisible to most people because it is baked into routine transactions. Every purchase becomes a signal of capacity. Every transaction becomes a filter, and filters determine extraction levels. Price discrimination pairs perfectly with inflation because inflation sets the baseline higher. Then price discrimination sorts who absorbs how much of the increase. Inflation creates the tide. Price discrimination decides who drowns in it. The most important part of price discrimination is not the pricing itself. It's the justification behind it. Pricing systems frame themselves as efficient, fair, responsive. They use words like optimization, personalization, dynamic adjustment. These words make extraction sound sophisticated instead of predatory. When companies talk about efficiency, they rarely mean for households. They mean for margins. When they talk about personalization, they rarely mean empowerment. They mean segmentation. When they talk about dynamic pricing, they rarely mean fairness. They mean monetizing urgency. The language sanitizes the practice. This matters because language shapes public tolerance. If price discrimination were described honestly, it would sound like this: charge people with fewer options more money so people with more options can pay less. Stated plainly, it becomes harder to defend. But disguised under abstraction, most people accept it. Acceptance is critical for the system to function. The system depends on households believing they are at fault, that they could avoid higher costs through better choices, that discipline and planning are enough. But choice is a form of privilege. Discipline cannot overcome structural disadvantage. Price discrimination makes inequality self-reinforcing. Higher costs reduce savings. Reduce savings, increase vulnerability. Increased vulnerability raises exposure to fees and urgency premiums. Exposure creates more extraction. This creates compounding disadvantage over time. Inflation accelerates the cycle. Rising prices force more households into constraint. Constraint increases exposure to discriminatory pricing. Exposure increases extraction. Extraction increases strain. The system grows more profitable as households grow more fragile. Fragility is monetized. This explains why lower and middle-income households feel like they are being squeezed from both sides. They are. On one side, inflation raises the baseline cost of living. On the other, price discrimination raises the cost of being constrained. The wealthy buy down their exposure. The poor subsidize the system. This is not about individual intelligence or effort. It is about position within the structure. A wealthy household can shop sales because it can stockpile. A poor household cannot stockpile because it cannot afford upfront bulk purchases. A wealthy household can prepay annual subscriptions. A poor household pays monthly and absorbs the premium. A wealthy household can negotiate mortgages. A poor household rents and absorbs annual increases. A wealthy household has transportation flexibility. A poor household pays surge pricing or loses income. The same system that appears rational from above feels rigged from below. It is material. A wealthy inhabit a world of options. The poor inhabit a world of constraints. Price discrimination monetizes constraints. This is why the system looks efficient on paper, but feels predatory in practice. Efficiency prioritizes the allocator of prices, not the absorber of prices. Most economic systems are optimized for stability at the top, not resilience at the bottom. This is why inflation and price discrimination do not destabilize the system. They destabilize households. Households absorb shocks. The system absorbs revenue. Over time, this reshapes class structure. Middle-income households slide downward through cost pressure. Lower-income households become permanently trapped in extractive pricing. Upper-income households widen their buffer. The middle class erodes not from cultural decay, but from financial mechanics. Affordability collapses quietly, not through recession, but through routine transactions. You do not wake up one day and notice the extent of extraction. You notice it gradually. Groceries feel heavier. Rent renewals shock you. Insurance quotes feel surreal. Bank fees feel insulting. Subscriptions feel endless. Most people internalize the problem as personal failure. But the consistency of the pattern makes that unlikely. Millions of households are experiencing the same pressure at the same time. That is not failure. That is design. If price discrimination were random, patterns would not be consistent across geography, industry, and class. But they are. People do not become irresponsible in synchronized waves. Structures change. The truth you are never taught is simple. You are not bad with money. You are functioning inside a system engineered to extract from people with fewer options. Once you see the structure, the confusion fades. Blame shifts from the individual to the mechanism. And understanding the mechanism is the first step in resisting it. If you want to keep breaking down how this system works and how it affects your daily life, subscribe and follow this series. Because the next layer of this problem is even deeper. And we're going to talk about it in the next video. If you want to understand how the system actually works, subscribe and follow this series, because inflation is only the first layer.